Right here is an 43% probability mean reversion setup. While other traders were chasing the trend higher, this indicator showed me the market was statistically stretched and primed for a pullback. What's even more impressive is how it quantifies probability using oscillator dynamics, not guesswork. In this video, I'm going to show you how it works, the best settings to use, and how to trade it properly. Let's get into it. To add this special indicator to your chart, first, head over to TradingView and pull up any chart you want. I'm using the 1 hour time frame on GBPJPY, but this works on any market, any time frame. Click on indicators and type in mean reversion probability zones. Make sure you select the one by Big Beluga. Now this isn't just another overbought, oversold indicator. This is completely different. Most oscillators just tell you the market is extended, but doesn't show you what the actual odds of a reversal is. This indicator solves that problem by quantifying the exact probability of price reverting to its mean. Once the indicator is loaded, you'll see the oscillator at the bottom of your chart. You can choose RSI, MFI, or stochastic. But here's where it gets really powerful. Above and below that oscillator are probability histograms. The orange histogram above shows you the probability of downward mean reversion, while the green histogram below shows you the probability of upward mean reversion. And next to each histogram bar, you'll see the exact percentage, but it gets better. On your main price chart, you'll see gradient-filled zones. Orange gradient means you're in a high probability down reversion area, and green gradient means you're in high probability up reversion zone. And in the top corner, there's a compact dashboard showing recent max up and recent max down values. This tells you the highest reversion probabilities seen recently, giving you historical context for the current reading. However, just trading signals like this is a recipe for disaster. You need tools that do more, like setting optimized trade targets, identifying volume, and filtering out bad signals, so you only catch the most explosive moves whilst avoiding sideways range. That's exactly what my tool does. And the best part, it's 100% free at the moment. So click the first link in the description and get free access while you still can. Now, to get even more accurate signals with this indicator, let's get your settings right.
Double-click on the indicator to access the settings panel. First, you'll see oscillator selection, RSI, MFI, or stochastic. Stick with RSI as it works best for most traders because it's the most widely understood momentum oscillator and generates the cleanest probability calculations. Next is length. Bump this up from 14 to 21 periods. This controls the look-back period for whichever oscillator you selected. Now for the critical part, the zone thresholds. Change the upper zone to 70 and the lower zone to 30. This ensures you catch true statistical extremes rather than just minor extensions. Under the Style tab, enable the table to see the recent maxes values, which provide essential context. Also, make sure up probability and down probability are checked so high probability areas are instantly obvious. Finally, enable panel labels to see the exact percentages at a glance.
Once that's done, click OK. Now let me break down how to trade this using a 3-part framework. The foundation is reading the probability histograms correctly. This is where most traders get it wrong. They see any probability reading and quickly jump on it, but fail to understand that not all probabilities are created equal. The orange histogram appears above the oscillator when it's in overbought territory.
But when you see small orange bars showing 20 to 35% probability,
you know that's not tradable. The market is extended, sure, but odds aren't in your favor yet.
Instead, you want to see orange histogram bars showing above 40%.
That's when the probability of downward mean reversion becomes compelling. For upward reversion, the same logic applies with the green histogram below the oscillator.
Wait for 40% plus probability readings on the green histogram.
Those are your high probability long setups. The next checkpoint is the gradient zone confirmation. This is where you validate that probability with actual price position. When the orange gradient appears on your main price chart, it means price is entering the high probability down reversion area. But don't just short because you see orange gradient. You need to wait for the oscillator to confirm exhaustion. Watch for the oscillator to start declining while in the upper zone. That's your momentum shift signal. For green gradient zones, the same process applies, but in reverse. The last piece of the puzzle is the dashboard context. This is what separates good setups from exceptional ones. Look at that dashboard in the corner showing recent max up and recent max down. For example, let's say recent max down shows 82%. That means the highest downward reversion probability recently was 82%. Now, when you see a new setup forming with an 85% downward probability, that's exceeding the recent maximum by 3%, which indicates an exceptional setup for a complete trade execution.
Enter when probability exceeds 40%, gradient zone confirms, and oscillator momentum shifts in reversion direction.
Place your stop loss just beyond the extreme and target the opposite gradient zone for your take profit. Just before we get into the best settings, don't forget to claim 100% free access to our AI indicators that catch the best moves across every market and time frame. Get instant access using the link in the description below before it's too late. Now, different markets require different settings for accurate trend reversals. For forex pairs, keep length at 14, set upper zone to 70, and lower zone to 30. Forex trends more persistently than other markets, so you need wider thresholds to catch true statistical extremes. For crypto, keep length at 14, but set upper zone to 75 and lower zone to 25. Crypto is notoriously volatile with extreme swings, so wider thresholds prevent you from fading moves that have more room to run. For stocks, set upper zone to 65 and lower zone to 35. Stocks mean revert more consistently than other markets, so tighter thresholds capture more opportunities while maintaining high probability. For gold, keep length at 14 but set extreme thresholds. Upper zone at 80, lower zone at 20. Why? Because gold has violent reversals but also trending persistence. So you only want to fade gold when probability is exceptionally high. Thanks for watching, and I'll see you in the next one.